Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today.
Good morning. It's Wednesday, February 25th, and this is your New York Open Brief. Three things stand out. The Federal Reserve's steady hand is pushing out rate cut hopes and firming the dollar. Trade policy is shifting but not escalating as tariff uncertainty lingers. And commodities are in focus with silver catching safe haven flows while oil faces a market share battle. Starting in the United States, a Boston Fed official signaled rates are likely to stay on hold for longer, and futures markets now point to the first cut only toward September. That tone is giving the dollar a lift, seen in a firmer move against the Swiss franc. Housing tells a different story. Mortgage rates are at their lowest in nearly 4 years, yet buyer demand is still muted as affordability bites. Meanwhile, in policy, Washington's trade stance aims for stability with China, while launching new investigations into industrial overcapacity and supply chain labor, and rolling out a temporary surcharge for some countries, with consultations promised rather than a unilateral jump in barriers. In Europe, softer Eurozone inflation and a confirmed weak German fourth quarter keep the rates outlook subdued. The euro has edged lower against sterling on the data, but the pound's support looks fragile, with one major bank flagging that sterling appears pricey as investors price a more dovish Bank of England after a narrow hold this month. Across the Atlantic, the European Parliament is pausing ratification of the EU-US trade deal, awaiting clarity on new US tariffs, another reminder that policy uncertainty still hangs over cross-border investment. In Asia, the yen continues to underperform as new nominees to the Bank of Japan's board are seen leaning toward reflation, while political voices push against further rate hikes. Australia's inflation surprised on the hot side, lifting the currency initially, but the Reserve Bank of Australia's governor signaled patience, tempering those gains. On the resource front, the United States is moving to rebuild downstream rare earth processing and magnet capacity, a critical link for industry and defense. And in oil, Russia and Iran are widening discounts to hold on to Chinese buyers, a sign of intense competition that can temper global benchmarks. Turning to markets, that Fed for longer message supports the dollar, weighs on rate-sensitive currencies, and keeps risk appetite measured. Silver is bid on safe haven demand amid trade and geopolitical jitters, while crude may stay range-bound as discounted barrels gravitate to China. In Canada, 2026 capital spending intentions slow, with machinery and equipment slipping, but structures and energy projects doing the heavy lifting, a two-track picture that leaves the loonie sensitive to trade headlines and commodity swings. It's a quiet U.S. calendar with a few Fed speakers expected to hew to recent guidance. The next big catalyst is likely next week's U.S. jobs report, with tariff clarity talks also on the radar. What you should be watching today: the dollar against the yen, looking for an uptrend if Japanese policy signals stay reflation-leaning. The pound against the dollar, a downside bias if markets keep pricing earlier Bank of England cuts. The euro against the pound, a soft tone if Eurozone inflation keeps underwhelming. The Australian dollar versus the US dollar, where rallies may fade if the central bank's patience outweighs hot inflation. Silver, with an uptrend supported by safe haven flows, and crude benchmarks, potentially capped by discounted Russian and Iranian supply. In short, sentiment is steady but cautious, with policy patience and trade friction keeping markets balanced between resilience and restraint.
That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.